As the economy continues to recover and we see more opportunities for renovations and new builds, what are some of the lessons that can be learned from the downturn?
I think the lesson we all should learn is about leverage. I think what happened at the end of the last cycle, a lot of hotels were bought at 90% debt and 10% equity with a first mortgage and mezzanine mortgage. And as soon as the recession happened and the numbers started falling off is when our hotel owners got in trouble. And if you use traditional leverage, which is 65 to 75%, you had a lot more flexibility in a downturn before you had to go talk to your lender about a workout.
I think one of the things that we've seen over this recession is that the industry is much more disciplined this time around than what they have been in past cycles. And that's evident by the fact that developers who could not get financing didn't spend a lot of time searching and they either took their project, they put it on hold, they canceled it, put all the paperwork into the files, and at some point down the road they're likely to revisit that development opportunity. And as lending comes back to the marketplace, that'll be a time when they'll look at getting everything back on board.
Well, I think we've all made adjustments to the cost model that will likely stay around for some time to come. And I would like to think that we've understood that we can't overbuild except to our own detriment, but I don't expect that will last. I think we'll probably go back, and as soon as things heat up and financing freezes up, you'll see development get robust again.
I think the lessons that can be learned is certainly on the front end of doing your due diligence, to take a look at markets and see that what can support additional supply. There's been a significant amount of building, particularly in our segment, the economy segment, and I think that there are some markets that have been overbuilt, and so I think that certainly people need to be very diligent with their analysis of particular markets.
Well, from our vantage point, number one, we want to be cautiously optimistic about the recovery. We think there's a lot of enthusiasm out there that may be anticipating a better and more robust recovery than we see. So as a result, I think we're going to be very cautious about our new development game plan.
Well, I think in every cycle we go through, we find out that we built too much. And then we hope to learn that lesson, and we never learn that lesson. But I think this time's a little different because the financing's not there pretty much to have any new development. So I think whether we learn the lesson or not, it's inevitable that there's just going to be less growth.
Well, I think, as far as new supply, I think you're going to see a restrained, pipeline of new supply just because the capital is going to be tougher to come by. Banks are not giving out capital, they're giving it lower leverage, and so you're going to have some partners that just don't have the capital to do the projects that they were able to do in the past. So supply will be constrained, which will be good for industry fundamentals to stay firm and grow occupancy and grow rate, and I think it'll be a positive overall for the industry.
Well, this cycle is a little bit different in the sense that with lenders coming back more slowly than they have out of other cycles, the lessons have been learned from the lending community, which will have a tendency to reduce supply growth initially. However, it's a competitive environment, and once lending comes back full force, I expect to see supply growth return as it always has.
Are you noticing financing is becoming more readily available for hotel projects, or are there certain segments or locations where lending is still very tight?
Well, lending still almost does not exist for new development. However, lending for acquisitions is almost all the way back to where it was. Probably the lead in that lending arena is the CMBS lenders. The CMBS lenders, I'll give you an example. We had a client that in December tried to refinance a hotel, and the key to refinancing a hotel is to get enough proceeds. And really could not get enough proceeds in December of last year, December of 2010. Went out to 25 lenders. One lender showed up, finally did a deal with a little bit less proceeds than he wanted. had a very similar hotel in May of this year, went out to the same 25 lenders. It was CMBS. 8 CMBS people showed up. They went back to that particular lender, particular final, let's say final 3 lenders, and said, you got to increase the proceeds from $38 million to $40 million, and they all said, we can do that. And so the CMBS lenders are very much on fire relative to like they were in 2007. Now, the traditional banks are still not back relative to being aggressive enough to, again, get enough proceeds for acquisition and the rates and everything else. But CMBS, under 6%, interest rates, 65% loan to value or loan to future value. So they are getting more aggressive. So acquisition financing is back, new development financing is not.
There is financing for new construction, and the financing is happening in the upscale and upper mid-scale segments. The brands that have wide consumer acceptance are the brands that are very attractive to lenders these days. And those deals can generally get done for, say, $15 million and under. And with a good borrower, a good brand, and a good location, the lender has a lot of comfort and historically, over the past few years, has been willing to do those deals. And we look for them to continue to do those deals in the future.
Financing is starting to thaw, but it's still somewhat schizophrenic. We have opportunities where banks that had been out of the market have gotten back in, but everybody's still very conservative, and the deals have to be under-leveraged in solid markets for the financing community to take a serious look at them.
Well, I think the capital markets are still certainly fairly tight, particularly for new build, new construction. Conversions, we are starting to see some credit markets loosen up. I think it's more on the local level. If you have a good relationship with your local bank, certainly we're seeing some opportunities there. Now, as we look up to expand up in Canada, a little bit different story. Certainly we have seen the credit markets have not been quite as affected up in Canada, and there seems to be a lot more people putting equity into projects, particularly for new build projects.
Well, I think that if you have relationships with either local or regional banks, that there are opportunities that are available today. However, they do have some pretty heavy restrictions in terms of debt coverage ratios and perhaps guarantees. You want to make sure you have a very strong balance sheet. So on that basis, yes, there's more refinancing money available.
Well, I think generally it's still very tight. However, if you've had a good relationship with your, lender and you've been on time, which is always a good help, then I think, the opportunities are still there. The coverages are a little bit different, the leverages are a little different, but you can still get money. New development ground up, still very, very tight.
We're definitely seeing it loosen up. It's definitely more readily available for new construction even, and then the repositioning plays that include renovation components, but the leverage levels that were attained in the past are still constrained. You're still seeing 50 to 60% really be more the norm on where the banks are coming in at. So that'll put a natural constraint on the amount of deals that actually can get done.
It's very tight in many segments, and I think will continue to be for some time. Now, for us, as a brand that currently is not in Canada, Canada is a real opportunity for us and presents a growth through development that really doesn't exist here in the States. There's many opportunities, particularly in Western Canada, where the oil industry is growing and small towns are in need of lodging where they haven't had any lodging opportunities.